Welcome to this session on national income and economic measurements. In this session, we will understand how national income is calculated and what are the various measures in economic terms which are used to check how good a country or an economy is doing. So let us begin on this. So to first to say a very common parameter is per capita income. So what is per capita income? It is total income of country divided by the population of that country. So it is the average income per person in a country in a specified year. So we can say that this is the income which an average individual would be earning in a country in a specified year. So per capita net national income, what we call as NNI, which we understood, is national income divided by total population. So whatever is the total population of the country, this is it. So per capita GDP or GNI, we can take it, right? The gross national income as we take it is GDP divided by total population. Why we calculate such a parameter? See, it is important to compare standards of living across countries and across times. So today, if we stand, what is the per capita income as on today, and what it was 10 years back? How much we have grown over that period? And you can compare across countries. How is India doing vis-a-vis Pakistan, or for that matter, USA or England or Canada, so that we know, okay, per capita or an average, the individuals or the nationals of a country earn this much amount, or they're able to produce goods worth this value. So it is an indicator of economic development, to be saying. And these are also very important to assess, how good are the government schemes working, how good is the welfare. And then one important factor is the inequality, because one of the ideas that is there in the Indian constitution is to avoid concentration of wealth. To avoid concentration of wealth, to reduce inequality in the country, we need to have policy measures accordingly. And only when we know what is the average value that an individual is earning, we'll be able to know, okay, how far are people from that individual value, what is the how broad is the spectrum, how far are the the two ends of the spectrum. So these are very important factors. And mostly we all understand, as we said, that real GDP is a very important aspect in this case, because nominal GDP, as we understand, has an inflationary factor to it. So it will not give you the right, picture of how a country is doing. So real GDP is a more important parameter. So as per economic survey, as a real GDP growth was around 6.4%. So this is what we roam around is 6 to 4.5% in last few years. And per capita net national income in rupee terms is estimated to be around 2,05,334. So this is the amount of money an individual Indian earns, or average Indian earns on in a year. So these are very important numbers. So real per capita income growth tends to lag the GDP growth, especially when population growth is high. So when population grows faster, there is a more tendency that that the real per capita income would even go slower, because we may not be able to grow that faster because the population is here. Now, it's a very simple argument. I'll explain this in a very simple way. That suppose the earnings of a country was rupees 1,000, and there were 10 people in that country. So average comes out to be 100, right? Next year, there is a 10% rise and it reaches to 1,100. But the population here rises by 20% rather than 10%. So now we have 12 people. So now this number will come out to be somewhere around 91. Why the number has fallen down? The basic reason that has happened is that now the population has grown faster than the growth in the GDP. So when population grows faster, our GDP growth is not able to match with it, and we are leading to a situation where our per capita income is falling down. So that is what it says. Real per capita income growth tends to lag GDP growth, especially when population growth is high. So that is the basic idea, because India is growing very fast. in population terms. So even when it is able to, do well on the GDP front, it fails to really deliver more, largely because of the population growth. So there are some challenges to it as well. Different between average and median is, skewed by high incomes. So when we say that, what is actually the people earning, so we understand what is average and what is median. Average is you take the total value of the income divided by the population. So total income by population, we come to average. We also call it as mean. Whereas median is when you put everybody in a line from the high to low or low to high, and you identify the middle value. So in many scenarios, it so happens that, few people who have very high incomes increase the overall average when the country is not doing that well. We are saying, okay, an individual is earning 2 lakhs, per annum in India. But if you really take it that way, so if I calculate 2 lakh per annum is around about what, around 15 to 16,000 rupees, or around 16 to 17,000 rupees per month. But is it so? That is a bigger question. The figure gets inflated because a lot of people are earning a large amount of money. They are pulling up the average, right? So this may not be the right, indices to measure, because this average kind of is pulled up by some high earning individuals or high net worth individuals, as we call them. They tend to pull because they are earning so much in a given year that they are able to pull up the others on an average basis. But when you put a median, wherein we are trying to identify the middle person based on the incomes, then that value may be much lower in Indian case, because we have a inequality is also there. But we'll try to understand how much unequal India is, and there's a different parameter to it. Second, there's a purchasing power difference as well. That is also a challenge, and inflation adjustment is necessary. If we do not adjust inflation, we will not be able to come to the right point, and that's what we discussed when we talked about the nominal and the real growths, the normal GDP and the real GDP. Now, there's another aspect which is related to this, and this is called purchasing power parity. Very important concept again. Purchasing power parity is kind of a concept which tries to, explain how across the, times as well as across countries you should be comparing. Some people say, that a person is earning so much of money in US, but that money, is it worth the same value in India as it in US? So let's understand this. So PPP is a method to adjust incomes or GDP or prices between countries to reflect different price levels. The idea is how much currency is needed to buy a basket of goods and services. So the idea is basket of goods and services. So because whenever a person has to live, he has to, he consumes certain kind of goods and services to live a life. So when he's consuming these kind of services and goods, the same basket of goods and services. So for example, if you're living in India and you are, buying a set of goods and you are availing some services, if the same set of goods and services are to be availed by an individual living in Canada for that matter, what is the cost he's gonna incur for that? So because same goods and services in India and the same goods and services in Canada, we assume that they are living the same standard. So the living standard is same. So let's suppose that, a, a family is there who is able to, live a good standard of living by buying goods and services worth rupees 70,000 in India. Okay, let's assume 70,000 as the number. Now suppose the same goods and services are being consumed by another family of the same number of people in Canada, and that is coming around, what you say, let's say $3,000 US dollars, okay, Canadian dollars. So they've spent 3,000 Canadian dollars for that. Today, if we take the value of a Canadian dollar is rupees 50, so 50 into 3,000, and we come to 1,50,000 rupees. Indian rupees. Okay, 1,50,000 of Indian rupees. So we can say here that 70,000 of money in India can buy the same goods and services which 1.5 lakh would be required in Canada. So this is India, this is Canada. Now you understand that you cannot say that a person is earning 70,000 here and the person is earning 70,000 here is the same. No, it is different because the same amount of goods and services required in India require a lower cost, whereas it is higher in a country like Canada. So here we are able to compare the living standards. Then we are also able to compute the poverty lines. What should be the poverty line when we say, okay, so many people are below the poverty line, and that has been fixed around $2 per day by the World Bank. $2 per day was the value. Now, whether the $2 per day is able to earn enough money, you know, to buy that goods and services which allow a person to remain above poverty line. So this is a kind of a good parameter, and inequality in real terms is also checked by purchasing power parity. So you would mostly see that the international reports like World Bank report or IMF report, they do classification comparison based on purchasing power parity. So in India, India's GDP per capita is about dollar 11,158. Okay, per year. Nominal per capita GDP much lower. So if we call it as a nominal per capita GDP, we are much lower. We are just around $3,000. So what does $3,000 comes out to be? Around what we from 2.5 to 3,000 is coming out to be around what we came out around 2 lakh rupees. Okay, rupees 2 lakh. This is the value of the, but in a PPP pattern, this 2 lakh rupees is worth dollar 11,000. And what does dollar 11,000 comes around to be? If I take an exchange rate as 80 or 85 rupees per today, this 11,000 would be equal to around 9 lakh rupees. So you can say that the money that an individual is earning, the per capita income of India in rupee terms without purchasing poverty was 2 lakh rupees. But when we brought in the purchasing power parity concept to it, that this 2 lakh rupee amount that a person has or buys in carries in India is able to buy worth goods and services which are equal to the value of rupees 9 lakh across the world if taken. This shows how much cheaper it is to buy products in India as a basket of goods and services. So when you say the economy is, it is cheaper, because at the purchasing power parity, we are much lower. So this allows, countries, people, mostly tourists come to India and they are able to spend lavishly because they're earning in dollars. And they find that the same goods and services which they would get avail in their own country or home country would be much higher than it is in India. So this is where you would see the value is coming around 9 lakh. That is a huge amount of money, 9 lakh rupees compared to 2 lakh rupees, because 9 lakh rupee worth is what the goods and services that an individual can buy in rupees 2 lakh in India. That is how I would explain it. So this PPP adjustment boosts the comparability. Because of local low prices are lower, India is able to have a nominal GDP is low, but per capita GDP on PPP level is much higher. But then there are limitations to it. PPP requires large and high quality of data for price levels. Basket of choice also matters. You may be talking about only goods and limited services. Maybe a person is more inclined to buy services which are of higher price and have not been accounted for. And then exchange rate volatility happens. What is the exchange rate today? And it may change. And then there are, some internal inequalities also that exist across the country. For example, Delhi may be expensive than tier two city in India, whereas Mumbai may be much expensive than Kolkata. So there's an internal inequalities that also which exist which are not really catered in such a scenario. So this was the basic, another very important basic concept of purchasing power parity, where we are trying to compare how a value of goods and services in a country compared to same goods and services in another country. What is the value of buying those goods and services? That's how we compare purchasing power parity, right? So that is the whole idea about it. Now let's move forward and understand another important concept. We talk about inequality to some extent in the previous, discussion, and now let's have a visual tool to know inequality. We know that India has a large population, and there are people who are on the higher end of the strata, and then there are people on the lower end of the economic strata as well. So this inequality can be a big concern when there is inequality in a country. The consumption is lower. Why consumption is lower? Because more individuals have less money and few individuals have a lot of money. So their ability to spend is also limited. This leads to a lot of issues. This also leads to, what we call as a concentration of wealth, and this concentration of wealth is not socially, politically very good scenario. So let us understand this with the help of some tools. So visual tool to see inequality is Lorenz curve. So Lorenz curve is a very important curve which tells us the inequality that exists in the system. So let's go ahead and understand this. It says a graphical representation of distribution of income. On x-axis, the cumulative percentage of population. So it is showing the population on the x-axis. And y-axis, cumulative percentage of income. So this is the population, this is the income. So we have, in a way, say we are starting like somewhere like this with 0, 0. So as we go this way, we are increasing the population area. And as we go up, we are covering the income aspect. Okay. Furthermore, now ideal scenario is that as we grow, as more population is covered, more income is taken care of. This is an ideal scenario where there is a total equality, and as every segment of population, so 10% of population means 10% of income, 20% population, 20% income, and so on and so forth, to an extent that 100% of population means 100% of income. But is it the scenario? Is it works like that? No. You may see that there is a population, large segment of population which has very low money. So we have reached, around 70% of them, and only 25% or 30% of the money is being held by the 70%. And finally, we see a big jump. This segment is the people who are the richest. They are the ones who are driving the economy per se, but they are also the ones who are leading to inequality. So now the more curved it is, now there are two kind of curves you can see. One can be, there's a straight line. Either the curve can go like this and rise, or it may more curved and rise. So the first curve, which I call as C1, and this is the C2, you see C2 is more curved, which is more unequal. C2 is representing a more unequal economy because, even at the fag end, almost there was no much wealth contributed. So this is the wealth and this is the population. So large segment of population, and still the wealth they are holding is very less. And this very small segment is holding a big chunk of the income. So that is why the more, you know, bend there's more curve, higher is the inequality. The more straighter it is to the this line, the lower is the inequality. So this is where it is trying to represent. Now see this. This is lower inequality. If I develop a curve here, it would be of a higher inequality. Okay. So lower on inequality and higher on inequality. So this is a very important concept. So these is what is called as a Lorenz curve. So now used in reports of inequality, mostly it is being used by, World Bank and IMF. Economic survey and World Bank analysis show how income and consumption inequality. The shape of Lorenz curve has been used in inequality reports and data with top shares, etc. So this is what we understand with the Lorenz curve. Now let us understand another important concept which is linked to Lorenz curve, and this is called Gini coefficient. Gini coefficient is nothing but the area, this area that is there under the Lorenz curve. This area is what we call as the area under. Is this area? No, this is not the area. Actually, it is this area. So I'll correct this. This area is not there. We are talking about the area under the curve. So this is the area. So as you know, we go more smoother, this area shrinks. Shrinking of this area is what gives you the right value. So this area is what makes the Gini coefficient. So when we talk about it, this is the area, the more closer we are, the Gini coefficient reduces and we reach to what we call as inequality. If there is right up there, it will be completely, totally, on that part, and we will have an inequality. Let's understand this. So this is basically what, this is a single number between 0 to 1 or 0 to 100 summarizes inequality. Derived from the Lorenz curve, 0 is perfect equality. So if I have a curve like this, which I was talking, right like this, so there is no area between this. 0 is what is perfect equality. And the one is perfect inequality where it is completely like this. The higher the Gini index, the more unequal the country is. That means if I have a curve like this or a curve like this will be higher on Gini coefficient because more area is being covered by this curve. So higher the Gini coefficient, higher is the inequality in a country. So basically we are coming at Gini coefficient is the area which is there, under the curve upon the total area that should be there under the total curve. So it's upon the total area upon the area under the curve. So when I come to this total area, this is very important aspect. The Gini index measures the area between the Lorenz curve and the hypothetical line of absolute equality, or the gap between the two, expressed as a percentage of maximum area under the line. What can be maximum area? Obviously, when this is the Lorenz curve we have made. So, and this is the scenario under which we are trying to cover. So this area, if I mark it like something in this color, so what is the ideal scenario? This is the whole area. Okay. So this area full is the total area actually. But do we come to this area? That is a bigger point discussion. So when I take this, but what we are going to take is that there is a line there. This is how we are trying to understand. So we are saying this is the area we are talking. This is the total area, and this is the under the curve. Right. So these are very important aspects. So now in such a scenario, the bigger the gap, the more unequal the country is. Make it easier to compare across countries and over time. So that is why we use this. And remember, India is one of the most equal societies. Here, India is doing really well. Most equal societies today. According to the World Bank, India's Gini index stands at 25.5, and I've written it 25.5, making it the fourth most equal country in the world after Slovak Republic, Slovenia, and Belarus. So India stands at fourth rank in Gini coefficient because lower the better. The Gini coefficient, lower the better. India falls into moderately low, and this category is between 25 to 30. If India is just able to improve its inequality further and is able to reduce, we will come in the low inequality group of where the value of Gini coefficient is below 25. And India will do really well to achieve that. So that is kind of a concept where India is saying that India is not one which is promoting concentration of wealth. Income is getting equally distributed among people, and that is how it shows, right? So this is a very important parameter we were able to understand with the Gini coefficient. Now, there's another very important curve which is related to this, and the economic theory is called Phillips curve. So we understood Lorenz curve and we understood the Gini coefficient. Now we will take ourselves to another level and we'll understand what we call as Phillips curve. So it's an economic theory or a curve showing an inverse relationship between inflation and unemployment. What is inflation? Inflation is general rise in prices, right? So whenever there is a rise in price, we are able to, understand it. And let's understand first, I think, the idea of inflation, and then we'll come back to this Phillips curve. So let's go forward and understand inflation first. What is inflation? Inflation is when we say, last year I was able to buy vegetables at a price of, say, a set of vegetables at a price of, say, rupees 100. Today is the same. This is last year. Okay. This year I went and I bought the same set of vegetables at, current year at 130. So this rise, now see the goods are the same, 130 by 100. So it is a 30% rise in inflation. So general rise or a sustained general increase in prices of goods and services in an economy over a period of time is called inflation. Okay. So basically what we're trying to put across is that whenever the prices rise, they are not always because we are buying more good. It is also because things have gone expensive. So when we're spending more, it doesn't always mean that we are actually buying more goods. It may also be maybe buying fewer goods, but the price of those goods we have bought has gone up. So what happens when inflation comes? Let's understand this. There are a couple of very important concepts that we are dealt with inflation. So when inflation comes, it has an impact on the purchasing power. So your salary is supposed 25,000 rupees. You're drawing a salary of 25,000 rupees. You could buy goods worth, say 20,000 rupees and you saved 5,000 rupees, right? Now there is a 20% rise in the prices, whereas your salary has gone up only by 10%. So now your new salary with a jump of 10% has gone from 25,000 to say 27.5. Whereas your worth of goods was 20,000 has now gone with a 20% rise to 25,000. So this is your income and this is your expenditure. Earlier you were able to save 5,000 rupees. Now you're able to save only 2.5 thousand rupees. So your purchasing power. Now if you want to spend extra and buy another product, you could buy worth 5,000 earlier. Now your kitty has only 2.5 thousand rupees left. So your purchasing power to buy another item has gone down now. This is what we call as purchasing power declines. So now this is one aspect. Another aspect we can also understand that you had 100 rupees. Okay, this was one understanding. I'll give you another very important understanding in this. Suppose you had 100 rupees and you could buy 2 kgs of potatoes. Okay. Now the price was because placed at rupees 50 per kg. Now because inflation has gone up and now they cost rupees 70 per kg, the same 100 rupees you will be able to buy only around 1.5 kg of potato. The rupee 100 remains the same, but the power of that rupee, purchasing power of that rupee 100 has declined from 2 kgs to 1.5 kgs. So it is the decline in the purchasing power of money. The same money that could buy more goods earlier of 2 kg of potato was able to buy only 1.5 kg because the price has gone up, and this rise in prices is what we call as inflation. So that is the basic idea of inflation. Now let us understand why inflation comes. So inflation can come for a couple of reasons. One is called demand pull inflation. When there is more demand of goods, that is when inflation comes. So why would so happen? This can happen in a scenario where the people are able to buy more goods. Why are they able to do? Because their incomes have gone up. What we call as a disposable income could be one reason. So now people are earning more, they have more money, so they're able to buy goods. This could be one factor. The other factor could be there is a requirement of a good. For example, when COVID came in, there was a demand for, the masks. So everybody wanted to buy masks to protect themselves from COVID. So in such a scenario, the prices of, the demand was more, the supply was lower, thus they was being sold at premium. So this is when we say a premium is being attached to it. So 100 rupee thing, first let me give an example of, suppose five people were there to purchase and there were 10 goods available. So there were five purchase requirements and 10 goods were there. Demand was of five and there was a supply of 10. Fair enough. Now suddenly the demand has gone to 15 and the supply could only be increased to 12. So what will happen? There'll be a, because there is a mismatch in the pricing and the demand and the supply, what will happen? The prices will go up to match it. So prices will go to the level where the demand comes down by itself. Not everybody would find it worthy to buy it if the prices go up. Suppose earlier it was 10 rupees a mask. People said, okay, I'll buy two masks. Now suddenly the price has gone to 15 rupees and they say, okay, one would suffice. So what has happened? Because the prices have gone up, the demand has come down. So it is said that, the demand and supply balance themselves over time. And that is what we called as market forces. Okay. So basically what happens is that the demand matches the supply. If they are not at equal stage, either of them will go, demand goes up, either the supply has to match it. If demand goes up, supply matches, then the price remains at the stable. If demand goes up and supply is not able to match that, okay, is lower or not able to match it, what will happen? Prices will go up. Once price goes up, demand will itself fall down because not everybody is ready to spend more money on the same product. So when demand comes down and the supply is there, then the matching again happens. So price is what is able to bring that, equilibrium again. And that is where we call as market discovered price. This, when we talk about the market discovered price, this is what is market discovered price. There's a demand of goods, there's a supply of goods. If there is a matching, the point at which they match is what we come as market price. If the demand goes higher, the supply remains the same, the prices will rise. And the vice versa will also be true. We'll understand that also. But just to give a hint on this, I'll say if the demand is low of a product and supply is there, so what we call as a glut situation, you would have heard about the word glut. When there is mass production of goods, or agriculture produce has gone high, but there is not that much demand, the prices crash, right? So when these prices fall, what happens? This is more because the supply is more and then there is prices, overall prices come down. Why? Because supply is high, demand is low, the prices go down. So when we say demand pull inflation, it is more because there is a more requirement of the goods. So when aggregate of demand exceeds aggregate supply, too much money chasing too few goods, consumer demand rising strongly after stimulus. This can also happen and we'll understand this. So whenever, you would see in a festive seasons or in a season where, more money is being brought into the economy, what is happening? This is pulling up the demand. So when the demand goes up, the supply is not equal, inflation will go. Then there is another form of inflation, or again, inflation is general rise in prices of goods, and it is sustained. Cost push inflation. What is cost push inflation? When the cost of the goods has gone up, and these are goods where which are important, so they are less discretionary, the inflation would impact. So this can happen because of multiple reasons. It could be because there is a flood in an area, so the amount of effort that is going into it, or to make that product available, is more. So when the causes are increase in cost of production, wages, raw material, energy. For example, there is an import based. Let's take an example of this. A very good example of cost push inflation is, so there was a rise in the prices of cars some time back. There was no discounts available. Why is it? Because there was an issue of importing of chips which were being used. So this, because there was a dearth of chips, there was less on supply of the chips. So few cars were being made, and those cars now were costing more, thus leading to higher prices. So leading to producers to, what happens? So when the cost of input goes high, the producer transfer is to customer, or the consumer. So rising fuel prices, if government rises because the crude oil has gone expensive, government increases the prices of the fuel prices. So that is a cost push inflation, right? Then there can be wage price inflation also. When workers demand higher wages because they also want better incomes. So they demand higher wages, and wages is one of the component into the as an input. So when wages are gone higher, which are required to produce a set of goods, has gone up, the overall cost will go up. So overall cost when goes up, it increases what we call as inflation. So when workers demand higher wages to keep up with the rising cost, business raise prices, and wage spiral happens. So what is wage spiral? Let's understand this also. It will be a very good concept if we are able to understand this. Okay, so what has happened? Wage spiral we were discussing. So what can happen in such a scenario is, now employees are asking for higher wages. Okay. So when they demand higher wages, what will happen? They get higher wages. So now this wages is one of the components into the goods. So goods they are producing. So goods has a cost to it. And what are the cost factors involved? Raw material, machinery, right? Maybe electricity and other thing, and the wages that go to it. Now, when the wages are increased, the overall cost goes up. When the cost goes up, now what happens? Any good is sold in a market price. So the sale price of a good is what? There is a cost price and there is profit. And say logistics. Now the three components attached to a sale price. Okay. So there's a cost price, there's a profit, and logistic cost. Cost price has gone up because wages have gone up, right? Now when the wages have gone up, cost price has gone up, sale price will go up, otherwise the profit will go down. To sustain the same amount of profit, the sale price goes up. Now when the price goes up, it leads to what we call as inflation, because the price has gone up now. Now when this goes up, what happens? The wages that they were drawing, they asked a jump of say 10%. Wages were increased by 10%. Because of their increase in wages, the prices also go up by say 7%. Now the effective increase is only of 3% for them. So they were thinking that they will be better off by 10%, but their betterment is only 3%. Then they again ask for a rise of say 5%, and then this again goes in, and this is what happens. So wages increase leads to inflation, and inflation again makes them push towards increase in wages. So this is this cycle, and this is what we call as wage inflation spiral. Because they are asking every time an increase in wages, this is also adding to the cost of the goods. Now, how can we improve this? If wages go up, but the overall cost does not go up, is how we can say it has become more efficient, and thus the sale price is not affected. Thus, the increase in wage would not lead to induced inflation. But otherwise, if wages go up, then the cost goes up, then the final price goes up, leads to inflation, and then again they are not able to, the increase in the wages is not able to sustain the expectation. It again goes into the spiral. So this is what we call as wage price spiral, right? Now let us understand the other concept is this is more of a wage price inflation. Structural inflation. So caused by structural bottlenecks. Example, we'll understand this. Let's go in and understand this on a more clear basis, and we'll be able to appreciate why it is important aspect of it. So let's just clear this up, and then we will go and understand how the concept of this structural inflation is. So now what we just understood in a structural inflation, I will explain this in a very different manner. Same goods, we take it. To produce these goods, we required a raw material. Then we required some machinery. Then we required some kind of a, you know, electricity consumption or other thing. And then we required was wages, right? Once these goods are produced, they are then transported, right? And they reach. So there's a cost to it. There's logistic cost to it. And then we get a, so and a profit is added to it. And then we had a sale price, right? So we are moving in this direction. So basically what has happened now, you understand this, that all these components added up to make a good and we call it as cost. We added a logistic and profit. Now suppose the raw material is coming out from a place where there are limitations of extraction. Suppose it is steel. So we need, what to call iron ore. The product is suppose steel. The goods we are producing is steel. So we need iron ore. Now, suppose the mining of this iron ore has become difficult because there is rainfall in that area or there is disturbance in that area. So the cost of the raw material can go up. If the factories are not approachable, reachable, there is limitation or there is more bottlenecks in that, or there are custom issues and other from importing, this will also lead to increase in cost of the machinery. Similarly, if we do not have good infrastructure like the power grids, or we do not have hydraulic power plants, or we do not have the thermal plants working properly, the cost of electricity will go up. All these factors are structural factors. When they all go up, the cost of goods will go up. And suppose we do not have a very good road rail infrastructure. So these goods produced do not get delivered efficiently to the market. In such a scenario, this will also increase the cost. Either the profits are to be compromised or the sale price goes up. So when all these factors, the all structural factors are as a bottleneck, what we witness is a rise in the overall price of the good, leading to inflation. So this is what basically it is. Caused by structural bottleneck like supply constraint, infrastructure deficits, agriculture productivity issue. See the same point, rather than iron ore, if we take it as a food item, also has the same repercussions. So this is very important aspect to understand. Now there can be another kind of an inflation we call as a hyperinflation. So what is a hyperinflation? So whenever there is a, there can be sudden rise and or spurt in inflation. So this hyperinflation has been witnessed in few countries when the prices suddenly jump, and this is more hyperinflation is more not only due to the structural issues but also due to economic stability. So when we're saying this something called hyperinflation is happening because suddenly the value of money has gone down. And what is money, we'll understand it as we go in the next session. But for the time being, we'll just understand the value of money has gone down drastically. When does value of money goes down? When there is loss of trust in the government of the day. Because money is what? Money is a instrument to buy and sell goods, right? So if this instrument loses value because it is like a debt, when you have 100 rupee note with you, what does this 100 rupee note signify? It signifies that if you were to take this money to Reserve Bank of India, they will return you goods worth 100 rupees, right? That is the value of 100 rupees. Suppose the country or the government does not possess the potential to refund or pay or give goods worth 100, the value will go down. Suppose they say, oh, we'll able to give you value of goods worth only 20. So suddenly this 100 would be equal to 20 rupees, right? Because they're able to give you goods worth 20. So, this is how the economy basically works, is on the presumption that government will not fail. But where governments fail or they're not able to hold up or their, sovereignty is in danger, the value of money goes down. So it is, very high and out of control inflation, not relevant to India. It may be relevant to countries like Zimbabwe or, Venezuela. So these countries have witnessed some, abrupt rise in prices, and that is more attributed to their economic structure and the confidence they got. Then there's another form of called deflation or disinflation. This is slowing of inflation rate. That is disinflation. There is still inflation in it, but it is slower. So disinflation. What has happened? Inflation still exists, but at a lower level. Very slow inflation is there. It is not rising as the levels of the other. That's disinflation. And deflation is when there is a fall in prices altogether. So when the fall in prices is called deflation. This is also harmful. We will understand this. This can also lead to another spiral. And many of the European countries and countries like Japan have been witnessing deflation. And this is not a good sign either. You may think, you know, de uh, deflation is a good idea. No, it is not. We'll understand that also. So disinflation is slowing of inflation rate, whereas deflation is negative inflation. Okay. So now let's go and understand the idea of, why inflation happens. We understood the basic types of inflations, which are pushed and pulled. Now we will go much more in detail and try to understand this. Many aspects we have covered. We'll try to cover these other aspects also. So let's start with, first is excessive money supply relative to output. Very good point. Okay. So what happens? Excessive supply happens and then there is a fall in the overall supply. Let's just understand this. And these are very important for, understandings, because they will set your basis of your other aspects also. So now let's understand this on how this works. So basically what happens is, whenever there is goods available, right, they are to be bought through money, right? So there's money in the market, you have money and you buy goods. So when you have money and you buy goods, suppose you have 100 rupees with you and you're going out to buy goods. So you bought, suppose there are a good is worth rupees 10. So you end up buying 10 goods for this, right? Because each good was worth it. Now suddenly what has happened, you have rupees 120 with you. There is more money given to you. Maybe you got a bonus and you have now rupees 120. Now what has happened is, you went to buy goods Now, if the price was rupees 10 only, you will end up buying 12 goods. But there are not enough goods available. So, goods are still the same. The price will increase. The goods are only 10 available in the market. Now, the same good, because you have more money, would be available at rupees 12. Because the overall goods in the market are only 10. You were able to buy it, it was okay. Now, because you had more money, so the same amount of goods which existed earlier now are chased by higher amount of money which has come into the market. And we'll understand how the money comes into the market. We'll go and understand that. Currently, just try to understand the concept that, chased money, the money which is chasing goods is gone up. So more money is chasing fewer goods. What will happen? People will ask, hi. So let me give me an example. Let me give you an example and explain this idea much better. Suppose, you know, there was a property, okay, and you know, there were no or very few buyers in the market. So the prices remained low. Suddenly, more interest has come from other cities, the citizen of the other cities who are living in other residents of other cities. They come in and they say, okay, this city is going to come up. So let us buy property here. So more people come in and they bring their money. Okay. When they bring the money, suddenly the property remains the same. Number of, the amount of land that is available is the same, but more money is chasing that land. What will happen? The seller will raise prices. That okay, now more people want my land, so let me increase the prices. And this increase in price is what we call as inflation, because more money is now chasing fewer goods. Okay. Second is demand pressure, increased consumption, investment, or government spending. So let's understand this also. So what happens is, whenever the expenditure is more, the more money is being spent out. What it is basically, money being spent out by, it can be spent out by a private entity, people get more money, or government has more money. So when the government launches, okay, we will undertake an infrastructure program in a given area, what happens? Suddenly there'll be production, goods will be purchased, infrastructure, inputs will be purchased. So if you were to make a house at a given time, and in the same time government is also building a bridge, now you also require steel for your house and government requires steel for a bridge. When government suddenly comes and says, okay, I need 1,000 tons of steel. Total availability in this market is only, say 1,100 tons. Okay. 1,000 tons has been taken. I'll take 1,100 tons. 1,000 ton has been taken by government. Now what is left is only 100 tons. Now all the people who want to build houses are to work for this 100 tons. So suddenly what will happen? The people selling this 100 tons will increase the price, because earlier they had 1,100 tons to sell and there were few buyers. Now suddenly when the government has come in and started building bridges, they have taken those 1,000 ton out of it, only 100 tons are left. So this will lead to increase in prices. So whenever government spending starts, increase consumption starts. Suppose more people plan to make houses in a given area. Earlier there was, this 1,100 tons, and suddenly there were only, 10 houses or 11 houses who required, each of them required 100 tons. Now suddenly more people have money and they decide to bring houses. So let's say they make 20 people are making houses now. Now those 1,100 tons of steel is required by 20 people, but each one of them requires 100. So what will happen? In such a scenario, those people, the sellers, will increase the prices. Once they increase the price, the buyers who do not have enough capital will say, okay, I'll wait, I'll not make the house now. But the prices have already gone up. It takes a time once it goes up to come down. So more money with the people, more people chasing a small amount of goods is what leads to inflation. Then, as I explained, supply shocks. There may be fewer crops has got damaged. So fewer crops are left, or oil price shocks, oil price has gone up. So these supply shocks also increase the value of the goods. Cost push, input cost or wages, we discussed that. Expectation. If people are merely expecting the prices to go up, they will start hoarding. And when they start hoarding, the fewer goods are left. Again, more money is chasing fewer goods, leading to higher inflation. Then there is a concept called imported inflation. When the the price is depreciating, the currency is depreciating. Let's understand that also. Now let's suppose that India is import dependent vis-a-vis the oil, crude oil. So India is highly dependent on crude oil for getting the petroleum out of it, or so India imports oil, crude oil, right? Now what happens? Suppose crude oil is available at say like rupees 50 per liter. Okay, let's assume that. And at this time, the value of rupee to dollar was 50. Rupee 50 was equal to $1. Let's assume this, right? So by $1, we could purchase 1 liter of crude oil, right? Now what has happened? Suddenly the value of the Indian rupee has depreciated. So now $1 Indian rupee is equal to 60 rupees. Now to buy the same goods of crude oil of 1 liter, we still need $1 because you're buying in a in the global market, and where dollar is the currency that is used. They don't identify Indian rupee. They say we want dollars. You give us dollar. Now the same 1 liter of crude oil is cost rupees 60 to India because the currency has depreciated. If it has gone $1 is worth 80 rupees 80, this 1 liter of crude oil will cost $1, which will be equal to rupees 80. Now see the difference that has happened because of this. Because the value is depreciated, we have come from 50 rupee a liter to 80 rupee a liter. When actually nothing has changed. Only that our currency has depreciated vis-a-vis the dollar, which is the dominant currency in the world. Right? So this is a very important aspect, and this is what we call as imported inflation. Now, what are the effects of inflation? Inflation, as we understood, erodes purchasing power. 100 rupees I had, I could buy earlier 2 kgs of potatoes. Now I am able to buy from this 100 rupees 1.5 kg of potato. So what has happened? My purchasing power has gone down because of inflation. Uncertainty discourages investment. So we are not sure there is a rise in prices. So people will not be ready to invest. They want to save because they'll be worried, if I invest and the prices go up, how will I make? So, and also less savings. We understood with that example. Earlier, a person was earning 25,000 rupees. He was able to buy goods worth 20,000, save 5,000. Now his salary has gone up to 27.5 thousand, but his expenditure has also gone up. He's only able to save 2.5 thousand. This is an example of where less savings may hurt fixed income households also. So where there is no rise in prices, your salary based and your prices are not rising, your income is not rising, you may face the brunt of inflation. Can fuel inequality. As inflation goes up, people are not able to get access to the goods, thus increasing inequality. Can lead to balance of payment issues if imports become expensive, and we just understood. Now India had dollars. Now to buy that dollar, India has to spend more rupee. When it is spending more rupee, India India has to give away more goods, more value of things, and this may lead to a situation where there is balance of payment, and we'll understand this when we go to import export. What is balance of payment? We are not going to that point right now, but we'll understand this as we go along. And then there'll be distortion in taxation and real interest rates. And let me explain it in a bit of a concept. Okay, let me explain what is also called a tax, creep. And I'll just explain this what happens. So this is a very important aspect how people end up in higher tax bracket due to inflation. Okay, so let's understand this in the taxation perspective also. So what happens is basically that suppose a person has an income of rupees 8 lakhs. Rupee 8 lakh is his income. He was in the bracket of, let's say, the new tax regime where 7 lakh was the limit. So above 7 lakh, only 1 lakh rupees he was paying as, on which he was paying tax. Okay. Now what has happened? His salary has gone up by, say, 25% because inflation has gone up by 25%. Okay. So salary has also been increased because there is a high inflation. So government says, okay, we'll increase your salary. Now he is drawing a salary of 10 lakh rupees. Right? He's because inflation and salary have increased, but he is still at par. He is whatever he was able to buy earlier, he's able to buy now because goods have increased and his salary has increased. But it may so happen at 10 lakh, he may be required to pay rather than 10%, 20% taxation. So now he is in a higher tax bracket because of increase in salary, but his overall purchasing power was still the same. So when he has to pay higher tax, he end up getting less disposable income. The income available to him is less. Why? Because the money, more money has got into taxation. So because your salary increases, you end up in a higher tax bracket, and eventually you are getting the money you are receiving after taxation is not worth what you were standing in the first place, right? So in such a scenario you will ending up being in a situation where now you are worse off by increase in salary because taxation has led to it, and this increase in salary is more attributed to the factor of rise in prices, right? So this is basically how it impacts. But then what, there's all not all negative on inflation. There is slight positivity in inflation as well. Let's understand. So mild inflation is good, reduces burden of nominal debt. Okay, as we rise, there's a debt will be there, nominal debt burden is reduced, can stimulate spending if moderate, prevents deflation, allows wage and price flexibility. So slight inflation is always desirable because if there is no inflation, then there is no incentive to work. If there is no rise in prices, there is no incentive for people to work. If prices are falling, why would you produce more goods? If you're producing more goods and prices are falling, less people will be buying it and there will be less. And then on monetary and fiscal policy, we'll understand what is monetary policy. Monetary is more with money, fiscal is more with taxation. Forces central bank to raise interest rates, right? When inflation goes up, government banks have to increase interest rates. This can impact the growth. We'll understand this also. Trade-off between inflation and growth is always there. Impact on fiscal deficit via inflation increases nominal government expenditure, indexation, and subsidies. We will understand this when we go to the fiscal aspect of it. Park it for the time being. When we'll come back, we'll discuss this in detail. So this was the basic idea we wanted to put across. And now let's go back to Phillips curve and understand. So it's an economic theory which says between inflation, now we know what inflation is and we understand unemployment. When unemployment is low, inflation tends to be high. Okay. Why is it so? You can understand when everybody is in a job, everybody is earning, there is more money, then inflation tend to be high, and vice versa. A stable and inverse relation between inflation and unemployment. They say so there has to be a decent amount of inflation for an unemployment to remain. If there'll be more unemployment, then inflation will be lower. Why? Because people don't have money. So fewer amount of money will be chasing more amount of goods, prices will not increase. So there has to be, some amount of inflation to match the unemployment. Proposing that economic growth leads to inflation, which in turns reduces unemployment. So helps policymaker trade off between inflation and unemployment. So how stagflation challenge this Phillips curve? What is stagflation? When there is low inflation, okay, but high unemployment. Occurs when economy experience stagnant economic growth, high unemployment, and high price inflation. So stagnant is the growth, inflation is there, but there is high unemployment. This scenario that contradicts the theory behind Phillips curve. So Phillips curve is basically saying when you have unemployment in an area is low, inflation will be there. If you lower the inflation, you say that is because there is unemployment is low. So that was the inverse relationship he developed. But then there were scenarios in 70s where it was identified that there was no growth. Economies were not growing. Inflation still remained high and there was high unemployment. So this scenario was challenged the Phillips curve. And how do I remember Phillips curve? With unemployment, Phillips is a company. So they give employment. So just a way to remember this is Phillips curve is related to unemployment and inflation, right? So this is the basic idea that is trying to put across. So we understood the inflation, and this one, the last monetary one, I will not discuss right now. I'll explain it in detail when we'll go forward and we'll understand what are interest rates and so that is all on this session. We'll come back and discuss, you know, price indices, types of inflation, and some inflationary data, the inflation targeting as well.